Welcome to the Jill on Money Show. It's Friday, June 28th, and we are here trying to help you make better financial decisions. And we do that by asking you to do just a little bit of work. Just go to our website, jillonmoney.com. Click the Contact Us button and write us a note. And if you'd like to join us on the air live, check the box. Mark does everything else. And if you don't want to come on the air live, we are doing emails. We're trying to be better. It's like we don't want to make you shy people feel bad about not coming on the air. And that is why we are always so happy to have the Friday Focus, which is sort of a new-ish thing that we've been doing, taking a focus of a type of question that we would like for the program every Friday. And today's Friday Focus is income taxes in retirement. And I know you don't like paying income taxes anyway, but during retirement is really tough. So let's just get into this. This is from Lee, whose subject is an inherited traditional IRA. And Lee writes, my father passed away. I'm sorry, Lee. And left a traditional IRA to me and my two siblings. At the time of his death, he was 83. He died in February of this year. He had not taken the required minimum distribution. As his heirs, are we responsible for that RMD, or does it matter since he passed away? I'm getting different answers from every source. We want to put each portion of the inheritance into inherited IRAs with the 10-year option. Is that the best idea? Thank you. Okay, Lee, Mark and I had to go look this up. So I went to the IRS website, irs.gov, and under the heading of retirement plans and RMDs, there's a little section which says calculating RMDs for designated beneficiaries after the account owner's death. Okay, so here's the deal. For the year of the account owner's death, the required minimum distribution is due. Okay, it is the amount that the account owner would have been required to withdraw, if any, but did not withdraw. So what you're going to need to do is before you divvy up this account into 3 inherited IRAs, you go to the organization where the account is held and you say, could you please make sure that you send us the required minimum distribution amount that was due for this year? And you make sure that that is done. And you take that out, and that's that. I mean, so as far as I'm concerned, the organization should be helping you with this, but get in touch with them. And in terms of once that's done, then you divvy it up into the 3 inherited IRAs, and you have 10 years to take it out. You don't have to wait till the 10th year. Maybe if, for each of you, it might be different, but you have 10 years to get the money out in total. So I hope that helps. It's a good question. I didn't know the answer. I always like to look up a question when I don't know. You guys always teach me something. Here's another question about required minimum distributions. This is from Cheryl. Cheryl writes, Jill, I turned 73 this summer, and I received a notice from my investment firm that I have to take a required minimum distribution of $11,635 this year. I don't need the money. After I take the RMD, pay taxes on it, what are my options for reinvesting the balance? Can I put the balance in a Roth? Are there other options? I don't want to be taxed twice on this money by putting it in a taxable account. Well, it's not exactly being taxed twice. The options are, I think, sort of twofold. One is you take the money out, you pay the taxes, then you do have to just put it in a taxable account. And no, you can't make a contribution into a Roth unless you have earned income. So if you don't have earned income, you can't do it. And you cannot count a required minimum distribution as a Roth conversion. The easiest thing is you take the money, you pay the taxes. You can either spend it, you can put it in your taxable account. Sorry. I don't consider that tax twice because remember, you didn't pay taxes at all on this money. And so it hasn't yet been taxed. So you're just paying the tax that would have been due. Okay. If you don't need the money and the fact that you're 73, maybe you'd like to do something else, like you could give the money away. If you really don't need the money and you don't want to pay tax on it, or you don't want to actually have it in a taxable account, you can actually execute a qualified charitable distribution. You can talk to the folks at the investment house. You can say, I want to send this money to a bunch of different charities via a qualified charitable distribution. The money will go to those charities and you will not have to pay tax on it, although you will not have the money either. So kind of depends on whether or not you're interested in doing that. I kind of like that idea. All right. Next up, we have a question from Mike, who writes, subject, need help deciding to spend and from where. I love spending. Let's do it. Okay. Mike has a pension, $90,000 net, and has a cost of living adjustment. Amazing. They live off of this money, lots of travel. Mike retired back in the fall of 2022. He hasn't had to withdraw any retirement funds yet. And he says, as long as I'm alive, we are comfortable. However, if I pass, my wife will only receive survivorship of $2,000 a month. Gross. Remember, he's getting 90 grand net. So she'll only get 24,000 pre-tax, and she will have COLA increases. Medical's covered. Neither of us has life insurance, too expensive. He retired unexpectedly. They only have about $15,000 in stocks in a brokerage account. They've got some bank accounts with $8,000. He's got a Roth 401k with $182. He's got an employee stock option program with $90,000. He'll get 6 equal payments this year. A regular IRA, $185 and $258 in a Roth. Regular IRA for the wife, $60 grand and $240 in a Roth. Okay. Taking money out of our regular IRAs would have been our withdrawal strategy, but if we use a qualified charitable distribution starting when I'm 70 and a half, all of my required distributions would be going to charity. I believe doing QCDs would be our best tax withdrawal strategy. With that, should I start taking money out of our Roth? No. Why would you take money out of a Roth? I don't see why you'd want to do that. So no, don't do that. You're going to get 6 equal payments from the employee stock option plan. So which is worth 90 grand. What I would do with that is I would make that part of my safe emergency reserve fund. Maybe I'll buy some CDs, or open up a brokerage account. That's fine. It's totally not a big deal, and leave some money in there. But if you need money, even though you're only, I know you're making money, this 90 grand, you're not claiming Social Security, I would start taking money out of the retirement account. You could wait to do your qualified charitable distribution, but I'm not even sure you should necessarily do that. You don't have that much money. And let's see how your costs increase over time. We do want the money to come out for, at a reasonable tax rate. But, right now you're probably in the 22% tax bracket right now, maybe even the 12%. If you need money, take money out of the IRA, and let's see how things go when you get to 70 and a half. You're still young. I don't understand people pay the tax. And his wife, if he dropped dead right now, he's screwed. His wife's in trouble. So no, don't do that. And I'm very charitable, but no, I don't think so. All right, I'm taking a breath. I need a break. I need a break from this, Mark. Let's take a break. Okay, Mark, we're back. It is the Friday Focus. We're talking about income taxes in retirement. Boy, you all are very stingy with your patriotism. You really just want to avoid paying taxes at all costs. I never worry about paying taxes. Mark, I think we are real weirdos in that. I mean, I want to take advantage of the rules to help us. But my friend said to me, if you change your residence, you have to make you'll pay less in taxes. I said, what do you mean? So talk about make your residence where your summer house is. Okay, fine. So I said, well, what does that mean? Well, you absolutely have to spend at least 6 months at the other place. I said, I'm not doing that. I don't want to be worried about this. I'm going to pay my taxes in New York City. I don't care.
Yeah, I don't get this mindset. Some of these people go absolutely crazy. I mean, it's a good problem to have. Would you rather the alternative? You have no money to pay taxes on?
I don't get it. Everyone calm down. Come on now. All right. All right, Mark, here we go. This is advice on strategy to convert pre-tax to Roth, and weaving in with a retirement question. Kira writes that she and her husband live in Northern California. They're 53 years old. They're going to retire at age 60. Now, earlier this year, they changed their contributions, 100% 401k Roth, right? So they went from traditional to Roth. And they wanted to take advantage of the current lower income tax brackets. Yay! Excellent. Okay. We make additional payments to our federal and state taxes via payroll deductions to pay the tax ramifications of this change, which was advised by our CPA. Good going, CPA. They got 2 kids, 27 and 22. 27 is fully launched. 22 works as semi-independent. She lives with her sister. Oh, I love that. We only pay for her cell phone and car insurance. 3 questions. You ready, Mark? Do we have enough to retire at age 60? A conversion question, and extra payments towards the mortgage. All right. They've got $200,000 of annual income. 401ks. Oh my God. 2.3 million in 401ks, just 70 grand in Roth. Okay. This is incredible. Roth IRAs outside of retirement, 25 grand, 50 grand in brokerage, 30 grand in cash savings. Rental unit. $135,000 value, $50,000 mortgage, 4.25% mortgage interest rate. House, $465,000. They owe $260,000, 2.875%. They're making extra payments on this, on both of those properties. The husband will get a pension. They don't have a lot of expenses. They've got a HELOC for an emergency, but in other words, they haven't drawn it. Let's do the questions. You ready? Number 1, Mark, I'm going to go backwards. Is it worth making extra payments toward the mortgage for the rental unit to pay it off early? No. Don't make extra payments. Why is everyone doing this? Just stop. No, do not pay this off. And it's a rental property. You're making $11,000 a year on the rental unit, and you've got like 85 grand of equity. That's an amazing return. So no, do not use $2,000 extra per year to pay off the principal early. Just leave it alone. Let it do its thing. Okay. Do not make every other week payments on your primary mortgage. It's 2.875%. Geez, people, come on. No, don't do that. All of the money that you are using to pay these extra payments, do me a favor, put in your brokerage account. Okay. Just build up the brokerage account. That's the number one thing. Now, the next, do you have enough to retire at age 60? Yes, you probably do. Because what you'll do at age 60 is you'll cease earning your 200 grand, but you don't spend that much money, 60 grand a year. And so it doesn't seem to be that big a deal. They want to convert 60,000 of their pre-tax to Roth in the next 2 years before the income tax cuts expire. Overall, it'll cost them 10 grand a year in additional taxes. And they would, what you could do is you could save up the money you were paying towards your mortgage and use that. They're going to use savings and brokerage. She also wants to claim dividends from company stock that she owns in her 401k rather than have them reinvested as I normally do. All right, Mark, what do you think about this? Do you want them to convert or not?
No, 60,000 for 2 years. I don't see the point.
Not worth it. It's like a drop in the bucket. So here's what we think. You have enough to retire at 60. Don't convert right now. Use your money and save up in your brokerage account. Okay. You've already switched over to retirement accounts, right? To Roth accounts. Now let's get back to what happens at age 60. From 60 to 7, don't claim Social Security at 67. That's what you said you wanted to do. We think you should wait until you're 70. Because at 67, they're combined as $6 grand a month, but it'll be more than that. And what we think you should do is from 60 to age 70 is to slowly pull money out of your retirement accounts and pay the tax that's due on it and live on that. You only need to collect the difference between the pension and your monthly expenses. It'll be a perfect plan. Pull the money out. And I think that's it. I think that they'll be good, but it's not, I get that you want to convert. I don't think in this case it makes a ton of sense. I just don't. You agree?
Yeah, 100%. Like I said, $60,000 is not, that's a massive account of pre-tax money. $60,000, it's not going to do a thing.
Yeah, not at all. Not at all. All right, that's it. That's our show, right? That's a wrap. Well, listen, if you've got a financial question, just give us a holler. Go to JillOnMoney.com, click the Contact Us button. Let us know if you'd be willing to come on the air live. Don't forget to sign up for the free weekly newsletter. It comes out every single Friday. And you can subscribe to us on the Odyssey app or wherever you find your favorite podcast. Please leave us a rating and review wherever you listen. Our music is composed by Joel Goodman. Mark Talercio is our executive producer and web king. We are distributed by Odyssey. Please lift someone up, change your work, change your wealth, change your life. Thank you for listening, and we'll talk to you tomorrow.